Good afternoon, everyone. It is October 9th, and as we say every week, let's get to work. We got a lot to do. We had a volatile week last week. We got an important week ahead of us. That stock market correction that we've been advising clients and investors on since late July, early August continues. We don't think it's over. We think we're perhaps primed for a short-term bounce here, but there are certain things that we want to be mindful of and careful of over the next few weeks. But fortunately, there are different ways to play defense, but different ways that we can be opportunistic as well. This type of correction does not mean that we need to go on a complete buyer strike at all. Our prime overweight in the growth portfolios and our blue chip portfolios remains energy. And despite last week's oil price and energy spasm as it related to the inventory report, which, by the way, we thought was incredibly bullish for our long-term thesis, we're buyers of that short-term dip. When we see that energy remains in a dominant long-term bull trend, we had an overbought condition that quickly got sold off last week, and we're now in a short-term oversold condition within a bull trend. That makes us really, really, really bullish. And we're using those as moments, as buying opportunities. And as it relates to the broader market, the prime theme is patience here. And I think we want to continue that. And so we're going to go ahead and get started for the week. The theme for this week's presentation is oil going bust? And quite frankly, think again, right? So despite this week's big oil correction or last week's big oil correction, inventories are dropping. That's all you need to know. Inventories are dropping. Valuations in energy are incredibly cheap, cheapest sector on the S&P 500, and global demand is rising, right? Those are the three things we need to know. Inventories down, valuations attractive, and demand is up. Nothing changed last week as related to that. Quite frankly, it was energy's turn to get hit. It is the only sector that had not gotten hit in this correction. And if anything, probably means that we're closer to the end than we are to the beginning of the broader stock market correction. So three things. We'll go through the employment report that came out on Friday, the stock market correction update. Where are we in the broader correction? And why did oil move lower? So the media buzz versus the facts. And I think it's important to pay attention to the facts. So next slide here, in terms of the employment, we see we call the bear media out there. Everyone is so ready to be bearish, right? And we're going into a recession, a depression, whatever you want to call it. Economy's holding in. Let's not overthink this, right? Like, we had strong labor market growth. When we look at that employment report, we came in over 300,000 new jobs. When you look at those periods leading up to a recession, right? Because that's the most important period as a stock market investor, is the period leading up to the recession. Once you're in a recession, you want to be buying stocks because you start to price in the recovery ahead of time. It's the period leading up to the recessions that is the most dangerous period for stock market returns. But when you look at that period, it's a period of deteriorating employment growth to a point where it's actually you have negative employment growth. You're losing jobs. We think of that 2008 period. We were about a year before Lehman Brothers where employment turned negative. We're at 300,000. Very strong private labor, private market employment growth. Government employment growth was strong as well. Probably want to see a little bit of less of that, quite frankly. But we're not on the page of, hey, we want the Fed to kill the economy so they can cut rates. That doesn't make intuitive sense. It's not good business. So we want our businesses to do well. So when we invest in a company. We want that company to make more money. And for that company to make more money, the economy's got to be good. And we think the economy is pretty good right now. It's not working for everyone. It can be better. Inflation can be lower. But certainly the economy is not bad, or it's not in line with what we see in the media. So strong labor market growth. Wage growth is slowing. That's a prime pipeline inflationary factor that we want to see slow. So we had strong labor market, slowing wage growth, and strong previous month's revisions as it relates to August and as it related to July employment numbers. So prior month revisions were up as well. So this was a very, very strong employment report. But underneath, when we think of the stock market right now, the stock market still got some work to do, in our opinion, because when we look at the cap weight S&P 500, which is still up around 9 or 10% year to date, the equal weight S&P 500, right? So when we strip out the impact of FANG, Facebook, Apple, Netflix, Google, Meta, I think I said Facebook already. When we strip out the impact of those stocks plus NVIDIA or Tesla, the market actually went negative for the year last week. So that S&P 500 equal weight was negative for the year. Why? Because those 5 or 6 stocks are up like 90% year to date. Everything else is struggling. Now, we've had pockets like energy that have really turned upward, and that's where our prime focus is right now. But that average stock, consumer staple, consumer discretionary, tech, non-FANG, those stocks are really struggling. So the S&P 500 equal weight continues to break down. So we need to see stabilization here. We need to see the S&P 500 cap weight hold at the 200-day moving average. It's really important. Now, short term, we're probably at some sort of short-term tradable bottom, in our opinion, right? Why is that? Put call ratios, as we look here in this chart, bottom right, put call ratios really spiked last week. Nothing like we saw, let's say, back in March, right? But when you get close to that 2-point level in terms of put call ratios, it tends to be a good area where you can call a short-term tradable bottom in the market, right? So even Friday, futures really got hammered pre-market on the employment report. Oh, strong jobs growth means the Fed's going to tighten more. The market was oversold enough where we had a pretty good reversal. You saw it in the accounts, you saw it in the market. And I think that broadly and intuitively makes good sense. When we look at the one issue that we still have is the total 3-month net new highs, net new lows is still broadly pretty negative, right? So more stocks are making 3-month new lows versus 3-month new highs. We want to see that decelerate and start to turn the other way. That can quickly happen when we get into a recovery, but hasn't happened yet. So we want to be careful is the bottom line. And then the other thing, of course, a lot of what's causing this weakness in the market is related to the bond market, right? These spiking interest rates. So what we see here, this is the TLT. So when interest rates go up, this TLT, this long-term government bond ETF goes down in price. We're getting closer to a panicky state in the bond market. We saw 71 million shares traded on Thursday. So we're getting closer where people are getting somewhat panicky. We saw it in the HYG as well, 139 million shares traded as a hit, a multi-month low. That said, when we look at the sell side, now one main strategist is above 5%. We personally think we get to 5.25. So short term, again, when we look at put call ratios, short term, we look at volume traded on the TLT to the downside, HYG to the downside. You probably get some tradable bounce here. I wouldn't be chasing those weak areas of the market, though. I wouldn't be chasing the banks. I wouldn't be chasing consumer staples or utilities. They're probably going to bounce here. If you have some exposure there, maybe use that as a moment to offload a little bit more because the banks look really, really weak here, especially from a technical backdrop. But the bottom line there is, of course, is that we do really think that the bond market continues to migrate higher into the 5s over the coming months. Now, last week, it was energy's turn to get hit. Now, why was that? Well, the whole idea was that demand fell week over week for gasoline. So we wanted to spell a few notions that are out there. The first is that demand fell because of the economy. Well, we saw the economy was really strong as per that employment report, right? So the economy did not fall out bad as it related to the data reported on Friday. What we saw was that New York was basically shut down because of a flood. That's a big city. There's a lot of people not refilling gas in their cars. So that was a really big one-off that we want to be mindful of. The other is how gasoline stations refill their own inventories on location, right? So when you're getting toward the end of the week, Friday or Saturday, prices are going to drop as sold by those refineries. You wait a couple days, right? You don't go in there and buy your gasoline. And so a lot of these gas stations, what they did was wait a few days, wait for those prices to come down, and then they went ahead and purchased those gasoline inventories on site so that we could fill our cars up. What we haven't actually seen is commentary by the gasoline station saying that the actual people in their cars are filling their gas tanks less. We just haven't seen it. We're not seeing it in the miles driven data. And what we've actually seen anecdotally from commentary from gas stations is that we're seeing actually a big, strong surge back just this past week alone in terms of miles driven and people refilling because gas prices just came down a little bit. So here in California, gas prices remain pretty high, just shy of $6 a gallon. So here's the big thing I want everyone to pay attention to. Oil inventories, forget gasoline demand, oil inventories dropped again last week. We are at dangerously low levels. We're starting to get signs that China is turning around. India is accelerating. Europe is stabilizing. So if you get all these big components of the global economy that are in recovery mode, watch out. Again, we really do think, and again, it's not a guarantee at all, but we think that oil can go well north of $100. We threw it $150 last week. For me personally, that's a base case. So, and when we look at energy right now, the stocks are saying that we're part of something bigger. We're part of something, a trend that is part of a broader uptrend. So percent of stocks above that 50-day moving average down to 4%, but part of a strong long-term bull uptrend. So I think that's the most important thing there to pay attention to. In terms of performance attribution, what are the sectors that historically have generated the most alpha? Energy is the number one sector when rates are high and going higher. What are the sectors that generate the most alpha or outperformance in the market? Energy is number one. And we think this time is no different because the fundamentals are so attractive. So strong fundamentals, strong quant factors going our way. We think that energy continues its outperformance. And when we look at commodities historically, they remain historically cheap, going back to 1900. So we again see no reason or no dent to that long-term bull thesis. So summary, bottom line, be patient. There's no real signs of panic across the stock market. So if we see a bounce next week, don't go chasing the banks. Don't go chasing high PE growth stocks and technology. Don't go chasing the staples. But we are buyable dip. We are buyers of this dip in energy. Energy is the key here, in our opinion. So bonds are closer to a panic state. We think it's starting to make sense to extend out duration and lock in higher rates for client portfolios on the bond side. If you ask Warren Buffett what was the greatest gift of the early 1980s, it wasn't to buy the Dow or to buy the S&P 500. It was to buy the 30-year bond, right? And it didn't matter if you were a month early or 2 months early. So when we look at the long end of the curve, the 10-year, the 30-year, and some of the corporate bonds of those durations, I think it makes a lot of sense that if you're a retiree and you want to lock in some higher coupons for the next 10 to 15, 20 years, this is a big gift. That's what we're helping clients do right now. If you are short of income and want to use the bond market to give yourself a pay raise, give us a call, give your advisor a call. We're glad to help show you some of the options out there. And then lastly, we just continue to focus on sectors with strong long-term trends and use short-term weakness to basically back up the truck and buy more shares. Energy is basically the only sector that fits that bill right now. Cannabis is another sector that we really like. So give us a call, 888-543-3776. Give your advisor a ring, and we're glad to have a conversation in more detail. Thank you again and have a fantastic week.